A market cycle system, it's very simple. It's a system for defining uptrends and downtrends relevant to your time frame and how you trade those different phases. So how do you trade early in an uptrend? How do you trade later in an uptrend? How do you trade an early downtrend? This system kind of defines all of that for you and gives you a lot of clarity. Everybody's chasing performance. Everybody's chasing, the hot stock, the hot tip. But if you're acting on emotions, you're acting when the trend is already well underway, and we want to be participating early in the uptrend as the reward is worth the risk, and then exiting when that dynamic shifts as well.
That's essentially what a stress test is. It's the most important day during uptrends that gives you information as to how the leaders in the market are acting.
Trading late in a downtrend. Downtrends are typically shorter in duration than uptrends. You want to sell short positions into strength, cover into weakness. Monitor for relative strength. Like we said, build RS lists. Look for themes that are setting up together. As Ross says, look for overall groups that are building launchpad setups together and moving up the right-hand side of the bases. Look for stocks leading the market cycle and watch for potential uptrends and upcycles and watch for developing leaders. That's the key thing. Identifying the leadership and judging how they are acting will give you a huge tell, again, to what Ryan mentioned about the risk appetite and risk profile of the market currently. And watching the leaders will give you that evidence beforehand. Just this recent correction, this is the QQQ on the bottom. Here is PLTR in the middle, and then Reddit at the top. And Reddit and PLTR were really the strongest growth names, growth leaders. These broke, gap down to the 21 EMA, resolve lower. Not gap down, but strong reversal down, breaking many lows at all before the QQQ really started breaking down. So watching these leaders will give you that tell a few days before the market really reacts significantly. So that's why it's so important to watch them very, very carefully. So here's our RS example. This is PLTR. Note how it entered an RS phase on this day right here, and then it set up in a gap, and I actually tried it this day and the next day and got stopped out, but it re-entered on the 21 EMA pullback. So again, you're going to get stopped out, but then you want to benefit from when it sets up again and breaks through the pivots again. And throughout this, it held well above the 200-day moving average when the market was well below it. Big undercut, big move off lows, strong close on this day when the market faded a lot more off highs and had a pouring closing range. There's a lot of elements of relative strength to this name, and just point to the fact that this could be a leader in the next uptrend and a leader that you want to be focused on when a new uptrend starts and really takes hold, like we've seen the past 3 days. So welcome everybody to the Next Trader's Handbook webinar on market cycles. This is a very timely one as we're potentially starting a new uptrend currently. So there's a lot to cover. We'll talk about how to trade market rallies, how to use progressive exposure, and also how to protect yourself when a trend ends and we start entering a correction like happened in the middle of December. So a lot to cover today. Here's a little bit about the waitlist. If you scan here, you'll get some extra bonuses. We'll be sending out the Market Cycles Model Book Preview, a preview of the bonus model book that you get when you order the book and send us your receipt. And to receive that, just want to be on the waitlist. And again, you can scan this QR code right here to join that waitlist. You'll also receive all these previous bonus articles, as well as exclusive giveaways and exclusive and priority access to these webinars right here. So definitely join this waitlist if you haven't joined already. And hopefully you guys have found these articles nice and timely and valuable as well. Here is today's topic. Again, we're talking about building a market cycle system, how to trade market rallies, how to use progressive exposure, how to spot, key relative strength leaders early on. And this coincides with chapter 8 of the handbook right here, which, as I showed previously, we finally have the physical copies here. Super excited to be, holding this in my hand. And again, if you haven't picked up your copy, you can click the link in the description to access yours and make sure you grab yours as well. We thought we'd start this off with another great quote from William O'Neill. He's got so many fantastic ones, of course, and this one is at least 50% of the whole game is the general market. And there's a lot of depth to this very simple statement, and it's kind of the whole reason why we're doing this webinar. Tracking the general market and the overwhelming trend, the longer term trend, the risk appetite of institutions, that's really, at the end of the day, what's going to set you ahead and allow you to position earlier on when you notice those character changes early. And it allows you to protect your profits and eliminate or minimize those drawdowns when the trend shifts back down to the negative after an uptrend. So at least 50% of the whole game is tracking that trend of the general market. It's the M and CAN SLIM, so important, and really our focus today right here. And I think this is one of the key things that differentiates unprofitable inconsistent traders with, you know, profitable and consistent traders is being able to stay in tune with the market and, you know when to get aggressive as well as know when to get defensive as well. So this is a really important webinar, and I know you guys will dig it, and we've got a lot of great concepts to share with you guys. So here's the overall agenda. First, what is a market cycle system? How do you create one from a high level perspective? Then we'll talk about market gauges, trading a full cycle from rally to breakdown, finding leaders early, progressive exposure. We'll show some math behind that as well, which I think most people, you know, don't really see or don't fully understand. We'll discuss some other important concepts like stress tests, and also how to approach trading later in a cycle when things have been, you know, going for quite some time, and you know, you want to adapt a little bit to that situation. So this is going to be really good, and make sure you stick around until the end. All right, so first things first, what is a market cycle system? A market cycle system, it's very simple. It's a system for defining uptrends and downtrends relevant to your time frame and how you trade those different phases. So how do you trade early in an uptrend? How do you trade later in an uptrend? How do you trade an early downtrend? This system kind of defines all of that for you and gives you a lot of clarity. And like I said, I think this is one of the standout concepts that allows you to transition from a stage 2 trader to stage 3 or 4. So if you're a stage 2 trader watching this, you know, a boom and buster, you know, this is one of the key systems that you need to add to your process, to your overall trading system, to take that next step, you know, to level up as a trader and improve your performance. And like I said, what the system basically does is it gives you clarity about when and how to enter during market uptrends, and when and how to exit when uptrends end and we begin a correction or downtrend. And it can combine index analysis, trade feedback, market leader analysis. We'll be sharing a little bit about different tools that you can use to build your market cycle system. But a key thing we want to emphasize throughout here, and this is repeated over and over again, the best market cycle systems are not intricate. They are simple and robust. You know, the core of my system is just using the 21 EMA on the QQQ. That kind of sets, you know, is my guiding light, is what I say, what I like to say. So again, we'll emphasize this point quite a bit. But first, Ryan, before we move on, I want to hand it over to you to kind of talk through kind of your view on market cycle system. Why it's important for traders to develop it.
So one of the first things you want to be aware of is some of the stats. You know, William O'Neill says that 50% of his stocks move as a market, 3 out of 4 stocks follow the market, and you know, most stage 1 and 2 traders or phase 1 and 2 traders will always not have a market cycle system, and they don't know when it's what's a good time to step up exposure, when's a good time to hold back and kind of, you know, not be on the sidelines. With the recent market, you saw, you know, a lot of traders in April, in March, continuously trading on the long side when the primary trend of the market was down, right? And that's how we get a correction or a deeper correction, and we hit that bear market threshold as well. So this market cycle system, and what we'll discuss and how to build this throughout this webinar, is to keep you on the right side of the market. Now, the second component to this will be the type of trader that you are. As a day trader, you're looking for magnitude and momentum for that day. As a swing trader, you're looking for, you know, a momentum in the markets to be directional, be it up or down, doesn't really matter. As a position trader, right, more Ken Slim style or growth style trading, you're long only, and you're looking to ride those uptrends and then be on the sidelines when you're in a downtrend to be primarily cash. And then we have investors who kind of don't need that market timing element because they're looking at 5, 10, 15 decades, right, in terms of investing. So the market cycle system in this concept is for that day trader, swing trader, and that position trader to really be in the markets with high exposure when the market trend is quite clear, be it to the upside or the downside, and when it's choppy and it's not known, be on the sidelines as well. Most phase 1 and phase 2 traders what they will try to do is they want to be long, they want to be short, they want to do everything all at once. The best thing you could do is just pick a side in the market that you want to perfect. If you look at 10-year charts and 20-year charts, the market tends to trend higher, right? And that's just how it is. So to you know, start your career as I want to be a short only is really, you know, not a successful first step for you to be in the market. So, you know, we'll focus on how do you capture those uptrends, how do you capture that momentum. A really clear, simple system for that will allow you to transition from that phase 1 and phase 2 to 3 and 4 to be that consistent trader and then get into that performance phase.
Yeah, and Rye, if you can boost your volume on your side, please do so, or just talk a little bit louder. I boosted it as much as I can on my side.
Yeah.
But yeah, and I think what Rye just said is really important. Your market cycle system, like I say here, is going to be different depending on your time frame and trading style. Investors might focus more on tools related to monetary policy or longer term monetary cycles. What we're really talking about today is much more applicable to swing and position traders, especially of growth stocks. And that's defining kind of a daily, it uses daily data, but it's looking at those trends to capture those week-long moves, month-long moves of uptrends and downtrends between consolidations, corrections, uptrends in the market, especially in the QQQ, which is kind of our focus today. So again, depending on your time frame and your objective, the type of trader you are, you're going to have a different market cycle system that gives you situational awareness about when to be aggressive and when to be defensive as well. All right. So here is, a bit moving forward. Why do you need a market cycle system? Ryan mentioned this already. 3 out of 4 stocks follow the general market. This is based on studies that William O'Neill did, as many others have done as well. And you need a market cycle system to know exactly when to be aggressive and defensive, and to help smoothen out that equity curve, improve that equity curve, and try to limit those drawdowns when we go from an uptrend to a correction, because it can happen very quickly, and we want to be on top of that and minimize the damage as much as possible. And in addition to this, a market cycle system, a lot of people act in the market based on intuition or perceived intuition. Building structure around this and how when to be aggressive, when to be offensive helps, manage the emotions and take that part out of it, and just kind of build structure and consistency around our decision making in the market, which allows us to build consistency over time and perform over time. Consistent inputs allow us to analyze them, to tweak them, to improve the outputs, right? We can't improve a system if we don't know what consistent inputs we're inputting. And so again, just 3 out of 4 stocks follow the general market. We want to be trading with that overarching trend. And that's the focus of today. And I think we'll give you a really concrete system to do that. We'll show you how to build a market cycle system from scratch using the QQQ and 21 EMA. And just that simple system would have protected you during this correction phase right now, and started to get you aggressive or testing the market during this rally that we're experiencing. So there's a lot to cover today, and it's going to be really, really good. So again, if you're a Stage 2 trader, this is a great webinar to be focused on, and I think you'll take a lot out of this. All right, so what creates market cycles? Human psychology and trading have a relationship. Overall, the emotions and human psychology in play of all market participants comes together to create the price action that we see, the moves in the indexes, the moves in individual stocks. All of that is intricately linked, and that is what creates price action at the end of the day. And what's awesome about this is that human psychology has a pattern, and those patterns repeat themselves over and over again. We see uptrends, we see corrections, we see bull markets, bear markets. All that happens over and over again, and it's not going to happen exactly the same way, but those patterns are similar enough that we can create structure and build rules that define uptrends and downtrends for ourselves, and when to get aggressive at the right points and when to get defensive at the right points as well. And so what market cycle system does is it captures both the psychological and technical aspect to, again, build that structure, build those rules, so we have, guiding principles to govern how we're trading. Ryan, anything you want to add on this about human psychology and how it is displayed on the charts?
If we flip to the next slide, I think that will capture, much of what I want to say.
Yeah.
So in the markets, we have these cycles. They're mostly based on emotion, and price reflects that emotion in a really, really good way. So what happens is there's optimism, excitement, thrill, but then that bleeds into companies that have no business going up, but that leads to euphoria, right? If you have AI in your name recently, you were just going up. A company that was selling, drinks, put AI in their name, and they're up 100%. That is the euphoric part, and then from there we get into this deeper cycle of capitulation. Over the past 5 years, I would say we've seen every single type of this, on this slide. Every moment in the market has been completely experienced in the last 5 years. We have had the best uptrend coming out of 2020. We had the quickest correction into COVID. We had the recent, tariff-based volatility right? That led to, amazing, crazy down days and 12% up days, right? But the bigger part of this is this: once you understand where we are in the cycle, it will be infinitely easier for you to kind of look at the markets and kind of time the best moments, right? We don't want to be part of high volatility. We don't want to be part of rough trends that are not directional but sideways and will chop you into pieces, right? If we avoid just the worst down days in the market and the choppy periods and wait for that uptrend or those solid trends where there's optimism and excitement, or there's new themes that are coming up in the markets, etc., we're better off. And that's how equity curves get smooth, right? Where we remove all of the volatility, we remove all of the uncertainty out of it, and we wait for those uptrends. And that's really what we're focused on in this webinar, is to make sure you have high exposure in good markets and extremely low exposure in markets that are not good for swing traders or position traders or any type of trader, like we've seen recently in early April.
So let's keep going, guys. Again, this curve, I think, shows everything, and we'll be providing structure to show how this plays out on the charts so you can build concrete rules around it. And this is, I love this cartoon. You guys have probably seen it on social media before. Credit to Kevin Kelleher. I'm not exactly sure how to pronounce his name, but he's a creator of this. But I think this is a great reflection of how emotions, cascade in the market. And again, it's not going to be as obvious as this. It's more about extensions for moving averages, extension in the market, everybody focusing on NVIDIA. It's subtle and it happens over time. But again, over here on the left-hand side, it starts, I've got a stock here that could really excel. Then that gets repeated, excel, and it goes to sell. And then somebody says, this is madness. I can't take this anymore. Goodbye, buy. And then the cycle just repeats over and over again. Everybody's chasing performance. Everybody's chasing, the hot stock, the hot tip. But if you're acting on emotions, you're acting, when the trend is already well underway. And we want to be participating early in the uptrend as the reward is worth the risk, and then exiting when, that dynamic shifts as well. All right, so from a high level, how do you create a market cycle? And we're going to go from high level to really specific, guys. So don't feel like we're talking too much philosophically here. We'll show you how to actually apply it as well. But again, the goal is to create a simple but robust system that helps us define uptrends and downtrends. And how do we create a framework to objectively determine where we are in the cycle? We've got different tools that we can use: price action of stocks, indexes, secondary indicators, oscillators, breadth metrics. We'll talk a little bit about, the weaknesses of these later on. And we'll go through all full example, like I said, in just a minute, showing how to apply it with the QQQ and the 21 EMA. But here are some different tools that you can use. You can have ideas, moving averages on the indexes, net new highs, new lows, percent of stocks above the MA, number of setups, number of screen results on a screen that you review every day, every week, the quality of setups, a little bit more qualitative, but the quality of setups, and more ideas, stock gauges, which we'll touch on, name. These are all kind of popular tools that you can incorporate into your system. But what I really want to stress here is you only have to pick one or two of these. And some of them, if you do decide to use them, you want to make sure you go back and study to see if it actually works. Does name give an actionable signal? Does the bears versus bulls poll give an actionable signal? A lot of the things that we see on Twitter are, in essence, if you actually go back and study it, a lot of noise. They give a lot of false signals. And we want something that is robust and works throughout many market cycles. And for me, the moving averages and price is the most reliable thing. All of these can work, and you might find that they work well for you, but go back and study it. Don't just trust some trader on Twitter that you see and how they do things. Maybe they've studied it, maybe they haven't. Go and build your own conviction, and this is kind of a high-level concept that we're talking throughout these webinars when it comes to setups, edges. Don't just trust people blindly. Go back and try for yourself. Do a deep dive. See if it works. See if there's a better way, right? Because you want to build conviction, and the most confidence you're going to have in a system, including a market cycle system, is to go in and study it yourself. So these are ideas that you can incorporate and explore. But for me personally, and I'll talk about what I do later on, the moving averages on the QQQ, the 21 EMA, is the most key thing for me. And then I do look at a few of these other things, but this is really the most important thing. So think about what makes sense for your style. How do you personally interpret the market? Again, if you're longer term, you might be more focused on what the Fed's balance sheet is or something. Whatever indicator is relevant to the time frames and trends that you're trying to capture, that's what you want to incorporate into your market cycle system. Ryan, anything you want to add here, either about these tools specifically or just from a high level, how you think about finding tools that are relevant to you?
Yeah, I mean, I always feel traders use too many, and then
Yeah.
what happens? I used to do that myself. I used to have a volatility indicator, sentiment indicator, this indicator, that indicator, and usually 2 out of the 5 would say you're supposed to be buying, and 3 out of 5 would say you're not supposed to be buying, or 3 out of 5 would say you got to buy, and then 2 would say no, which will leave you in a state of confusion. So the lesser you have going on, the better. One
Yeah.
thing I've learned over the years is that some of them are best for extremes and other are best for your primary trend when it's established. For example, when we get these investor surveys or percent of stocks above 40 MA is a popular one, right? Those are best usually for extremes, and you can kind of scale into the market at extremes, right? Whereas the moving average is more of a more established trend. The slope of the 21, which we're going to talk about in a few, right? It's established trend. Liquidity is high again, and things are looking good in the markets. Whereas the other side of it is, traders try to take the extreme ones and use them as their primary, and it gets quite confusing. So exactly what Richard said, you got to pick one or two and have those be your main drivers for progressive exposure, how you scale into the markets when you're going to determine if it's an uptrend or downtrend, which we'll get into the next slide here.
Yeah. And I like what you said about having, things that you look at extremes versus kind of the established trend, because it's a good way to think about it. And always remember, as extreme as the Bears versus Bulls poll can get, it can get more extreme, right? Just because historically this means it's an extreme doesn't mean it has to revert. Things can always get more extended, all of that. So just some things to remember from a high level, taking a step back when you're designing your system. So components of a market cycle system and kind of what we'll be talking about today. First, trend definition, uptrend, downtrend, neutral. Cycle count, basically, how long has the uptrend been going on? How many days are we into an uptrend, or how many days are we into a downtrend? And then we'll also talk to me a little bit about journaling, journaling relevant data day to day, stress tests, extensions, anticipation, cyclical repetitive characteristics, developing themes as well. And then during my kind of daily routine, I like to note RS lists during a correction. That's part of my journaling process that helps me kind of, build a market cycle and build a focus on what to cover and what to focus on if we do start an uptrend after maybe we're in a late downtrend. So here are some basics. First, of course, you want to pick a market. And then, we've picked the SPY in this example. Then you can use a simple moving average right here. And basically, if we're above it, we're in an uptrend. If we're below it and trending below it, we're in a downtrend. So as an example, here is a downtrend right here below the moving average. Here is an uptrend below that. It can be as simple as that. You don't have to, use all these different data points and confuse yourself. Just keep it simple. Above moving average, good, uptrend, below it, bad, downtrend. Here is moving forward. This is kind of counting below the moving average. So the trend counts for the down cycle as soon as we close below the moving average. And then each of these days is one more day below it. So you kind of track this day to day and keep adding this. And this is 20 days below the moving average. And then this uptrend was 21 days above the moving average. Here's zooming out a little bit, just showing some systems chop as well, because there's going to be false signals. And guys, this is something we emphasize later on. No system is perfect. You just want to incorporate something that helps you. That's a guideline that's helpful to you, that helps you manage risk, helps you know when to be exposed, when to not be exposed. There's always going to be chop like this. And for me, kind of when there's chop like this after an uptrend, I'm kind of treating each position on its own merit. So if I do have positions, that doesn't mean I'm going to sell it because there's signals back and forth. But I'm just aware that the system isn't necessarily in a strong uptrend, so I might not be as aggressive as I would be when we get back in to a nice uptrend like this. So again, just using a simple moving average, we've got a downtrend defined, we've got an uptrend defined, and then when we're chopping above and below that moving average, we're more in just a chop phase in the system. And here's the strong uptrend later on. Right. Anything you want to add based on these slides and in terms of identifying? Yeah.
In terms of false signals and how to tackle those, because that will be a common question that we usually get. That's usually through intuition and experience and seat time and seeing multiple market cycles. And you have this voice in the back of your head that's kind of built over time, which will tell you that there's enough setups in the markets. You're seeing your edges and the setups are forming accordingly. That will help you build a bias at the end of the day as to what kind of chop it is. Is it the type that is going nowhere and your setups are failing, right? Remember that the market cycle is a huge component of everything else that we've learned up to this point. So if I'm seeing setups and I'm anticipating, in this case, we got a 46-day uptrend after that chop, usually in that formation, there will be setups that are showing that relative strength edge. They're showing the highest volume edge. The market is developing potential in that system chop area, so that you're looking at your focus list, you're maintaining your watch list, you're doing your daily routines, right? And then you will get into that phase where you can anticipate as to what the market is about to do, right? Recently in April, the last week and a half, we had a day where the NASDAQ was down 3%, and the stocks on my watch list were not down 3%. I expected them to be down 5 to 7 to 8%, and there was complete shift as to how stocks were behaving and how the market was behaving, right? So that information coupled with what's about to happen led to that 15% move in the NASDAQ over a span of 4 sessions, right? We rallied right up, but that potential or that system chop or whatever you guys want to call it, there has to be secondary information, which we'll get to later webinars. That's routines, doing your daily routine, do your weekend routine. So there's components to the system that we're building. Market cycle is one of them. There will be system chop. There will be areas where you're kind of confused as to what you're supposed to do. But over time, when you're phase 3 and phase 4, and you've seen 15, 20, 30, 40 market cycles play out, right, over a span of 5 to 6 years, it will just click, right? What we're trying to give you is a system where the phase 1 trader does not know what a market cycle is. The phase 2 trader has no clue how to, get rid of those boom and bust cycles. That it helps them get to 3 and 4, but then intuition, second nature, looking at the markets in a different way, psychology plays a bigger role. Those things come into play. But if you're phase 1 and 2, have a market cycle system for you to even get there, to get that seat time, to get that, build that, a voice that will talk in the back of your head to say, okay, things are about to go to the upside or the downside.
Yep, perfect. All right, and this ties in perfectly. Journaling your market cycle, keeping a log of your market cycle, and each day jotting down notes about the price action, the themes you see developing, the leaders, how they're acting relative to the market. If there are breakouts during a correction, that's something to note. All of this will help build that intuition. Again, if you're stage 1 and 2, this is more just collecting the data, while stage 3 and 4, you can really interpret and anticipate market cycle changes based on this data. But having this log will help you know when to position size the highest, anticipate stress tests and how to handle them, when to reduce position sizes, gain knowledge about the market environment and health in general before it's really reflected everywhere else. And also just keep a historical diary of themes and when they work best, which can be helpful in building model books and going back and studying yourself and how to improve. And just in general, journaling and collecting this data helps build your confidence and boost your mental game by staying on top of what's actually going on in the markets. And so what do you kind of need to track? Again, stress tests and uptrends, short covering rallies, which are kind of quick moves up when we're in a down cycle, what themes are leading, lagging, key breakouts and moves, and any kind of repetitive and cyclical market action driven by events. Whenever, if the Fed is really what the market cares about, that's kind of the overarching fundamental factor driving everything. If there's a Fed announcement, I'll kind of note that in my journal or note that on the chart, so I know that a big move was created by a Fed announcement or minutes being released. If inflation is what's being cared about, you can take a note about what CPI is doing. Right now, it's been all about tariffs and trade deals. So any news relative to that would be kind of what you want to include in your market cycle journal to keep track of what's actually driving the market. Right. Anything else you want to talk about journaling? We'll show an example in just a second, but anything else you want to cover
Yeah,
here?
I would say just noting these down, and over time you'll build, many years of and many cycles. What will happen at that point is that you will connect one market cycle to another market cycle, or things will feel the same from a technical perspective as to, hey, this reminds me of this particular, year that I was in. This reminds me of this moment in the market. Why it feels very similar, right? And what happens is that feeling that you develop as to what the market can do next is the place that you want to get to. And journaling the market cycle is how you get there, essentially. So there's some people that would say, hey, I don't need this. I don't need to jot this down. I can have muscle memory type of, thing where I can, remember things well. For me, I find it that if I write it down, if I have a journal of it, if I can refer to it, a situation back in 3-4 years ago, then I'm better that way, right? So whatever works for you, but just keeping a log of it will help you build that muscle memory. It will help you identify uptrends quicker and identify corrections quicker as well over time.
Exactly. And we want to touch on this concept because I think it's something to really recognize for yourself. What is a stress test? A stress test is basically after initial strength, maybe 7 to 8 days in, you might see your first one. You'll see a day where everything drops, right? Everything pulls back in at the open. And you want to see how things act. And this can be a great test of the rally attempt. And, you'll be able to sort the wheat from the chaff and identify the leaders that held up the best. And basically, add to that position, just focus on that a little bit more going forward. But they're negative in the sense that they cause a drop in the market stress test and they put pressure on things. But that pressure reveals the diamonds, right? It reveals the names that you really want to be focused on during the uptrend and how it and going forward at the next setup. Closes matter, and how we act after this stress test is really important. Do we bounce back immediately? If not, and we start to really roll over, maybe that rally attempt is just failing. But stress tests in general aren't things to really fear. They're things to expect and to plan for accordingly. So you want to be mentally prepared going into them, or after we've been up 3, 4, 5 days in a row after the start of a new rally. Know that we might have a pull in pretty shortly, and know your top ideas, know the names that you really want to hold on to, know the names that you want to work yourself into if there is a lower spot that develops on a pullback. All of this should be thought about before, so you're actually ready to go. You've got a game plan, all of that. Rai, I know this is your concept, so I really, you're the best person to explain stress tests.
There will be moments along the way as, when markets shift trends, majority of the market participants have to not believe in the move for the move to actually happen, right? If everybody is saying that the market's about to go higher, we're in that euphoria, type of time, psychological phase, right? Right now, we're kind of in that phase where the market's rallying up the right side. We've hit the market cycle count is +3 as of Monday, is going to be +3. Majority of market participants don't believe in this move. That's where we want to be. Now, what happens is along the way, to kind of convince them that we might pull back, or to scare them or whatever the case might be, the market pulls back to kind of keep them on the sidelines, right? And that's essentially what a stress test is. It's the most important day during uptrends that gives you information as to how the leaders in the market are acting, right? If, let's say, we pick Hood or Palantir or any recent breakout that we've seen during the week of April, the last 2 weeks of April, those stocks that are supposed to pull back, let's say 5 to 7% when the Nasdaq is down 3%, and they're only pulling back 1 to 2%, that's a clue. Those days, the stress test days, are the most important days. They give you the most amount of information as to what will happen after the pressure lifts in the market once again. So I always stress that the days that are up in the markets are the easiest. There's nothing to do. You're just looking at it. Everything's going up. You're part of the trend. Everything's it's not even a job at that point. You're just sitting there looking at the numbers move, right? The best days are when you get that pullback. How are your positions acting? How are the things that you're looking at in terms of a setup that's forming? How are they acting? What are they telling you while the market's pulling back, right? The news, the media, many people tend to look at indexes, and if the indexes are down, that's the only layer that they're looking at. But those days are the most important ones because those Palantirs and the Hood, Netflix, right? All those three names were not down as much. They were showing relative strength on the, down days in the market, and that was a signal. Hey, the market's going to, as soon as even if we get a slight update, these things are going to explode 20-30%, and which they did. Palantir did, Hood did, Netflix. Those are recent examples that I'm trying to point out that you guys can study after the stream today. So.
Yeah, I really like what you said that, if you're an average market participant and you're on this day or this day right here, and you hear on the radio or whatever you get your news, the Dow was down 1,000 points, there's no change in your perception of the market on this day or this day compared to this day right here, which was also down 500 points, 700 points, whatever it is. But if you have a market cycle system and you're studying this, you recognize that even though we had a stress test, we recovered quickly, we bounced back, reclaimed the moving average, we didn't fall through to the downside, and we're forming higher lows here. So this is very different if you have a market cycle system. But if you don't have a clue or aren't paying attention, that's where you get you're late to the party because the uptrend's already started, and by the time you start to get bullish, we're already in the middle of the trend or later in the trend. And that's really, the key thing here with the market cycle system is we want to prevent you from, going 150% long on this day, and then we get a stress test, you sell everything, and then it just recovers and goes without you. You try again up here, you experience another stress test, sell everything, and it goes up without you. We want to build structures so you're getting exposed at the proper points, managing your risk along the way, so you can participate early in the trend and benefit from that trend in your equity curve. That's really the bottom line of what we're trying to do here. So handling stress tests, here are a few things to think about. After you get initial traction on your positions, adjust stops to guarantee a higher low in your equity curve. Rye, you're huge on this. I definitely want to hear you explain it in just a second. Know your total open risk. We talked about how to calculate that in the risk management thing. Know how much total open risk you're willing to take on, whether that's 2%, 3% in the start of a new uptrend. You can anticipate stress tests, especially if you're more stage 2 plus, stage 3, stage 4. So you don't get ahead of your skis in terms of exposure. You're anticipating them, and maybe you're looking to even add on stress tests. And then for any position you have, simply having a plan if we do pull in hard and everything's pulling in at the open 3%, 5%, because that's how growth stocks do it. Having a plan helps you act, rationally in the moment, follow your discipline, follow your structure, follow your system. All of these are really important things to remember in terms of handling stress tests. Right? Anything you want to add in terms of preparing for these events and handling them in the moment?
You'll learn to anticipate them as the market, rallies. There will be these stress tests that happen along the way, and you will learn to expect them. A day or the week is not going to be just straight up, right? Uptrends are not straight up. Downtrends are not straight down, though most times they're starting to be now. So with uptrends, you'll say if you're making progress and your portfolio's moved 10 to 12%, it's a healthy move, thing for it to come back 4 to 5%, consolidate out, and then keep going, right? The biggest thing here is the information that's dished out on these days determines what happens next in the markets, right? Just focus on that. What is your portfolio telling you? If the NASDAQ is down 2% and your portfolio is down 12%, the market is about to pull in, because the stocks that you own, assuming they're leadership stocks, liquid stocks, stocks that are part of a good theme, which we'll get into the next slide, etc. If those stocks, when the Nasdaq's down 2 or going down 10%, get out the way, right? That's the type of information that you're getting. If the market's pulling back in and your stocks are fine, they're flat on the day, right? That's good information because the stocks that you own, one, are acting well. Second, the market leadership is also acting well. So there's nothing to be stressed about, right? The information that you're receiving on those down days is good information. You can use those days as putting on additional exposure, right? If you only have 30% exposure, for example, you can increase that to 45% then, right? So I usually use these days to either determine, do I need to play a defense going forward, or I can really press and get more exposure on because we're in a positive market cycle, right? So these are the best days. The other days don't really matter to me because they're just, you're either chopping, you get this, a candle with a narrow range, or you're up on the day. Those are very easy to just sit there and do really nothing on. But these days, when we're having a gap down open, what information are we getting in the first, 90 minutes? What information are we getting in the last 45 minutes in terms of a close? That's why it makes, the down days are much more important, assuming we're in an uptrend, than the up days are to me. So,
Yeah. And in terms, a little note on anticipating stress tests, something I always keep in mind is, how many days up in a row have we been? Are we approaching 3 to 5 days up in a row after a trend's been established? Are we a little bit stretched from the moving average after getting, showing some power off the lows? These are all things that, you can keep track of to say, hey, we might have one next session or the next 3 sessions. You're never going to be perfect, but you can try to, anticipate it so you can expect it and plan for it. To use this as an example, here we're up, 10 days almost in a row, almost straight up. Here we had a gap up, we fall through higher. We have an inside day that closed near lows. What happens the next day? We get a stress test and big down day, gap down, fall through down. That ends up getting supported, positive expectation breaker, and continues higher. But, being aware that we're up significantly over the past 10 days and that we're a little bit stretched in the short term can help you anticipate that we might have a stress test the next session or the next 3 sessions. That's just kind of what I keep in mind when I'm thinking and how I'm trading as well. So, Ryan, you want to take the importance of themes?
yes. So one of the things when you're looking at market cycles is, one, we're trying to put the market, the wind of the market behind us, right? 3 other four stocks follow what the market is doing anyways. The second part of that is if you're in a good theme, for example, the semiconductor theme in recent years, or the AI theme, or a particular biotech area in terms of pharmaceuticals, right? Or weight loss drugs recently. So you identify pockets of, you check off that the market's in an uptrend, but what's moving up? What's the next kind of the big thing? Software was huge in 2016, 17, and 18 that started massive runs of 400%, 500%, 800% in some of these names, right? So you want to identify which pocket. Yes, the market's moving up, but if we end up buying Bank of America stock, that's not going to move the needle at all. Or if we end up buying a financial stock or a company like JPM, that's not going to double your money in a short span of time, right? Yes, you will identify the trend. You will pick a stock that's, doing well. Maybe you go into a Coke or a Pepsi. That's not our objective in the markets. Our objective is magnitude, momentum, and being in an uptrend. When we're in an uptrend, having the most amount of exposure, right? So identifying themes within uptrends can be part of your journaling as part of your market cycle journaling, right? I always say, I want exposure in the AI space. I want exposure in the software space because I see 5 to 7 to 8 stocks in the same space, highly liquid, high market cap, moving to the upside. And if I am in those, right, and I'm deliberately placing my money in that particular industry while the market's going up, there's a greater chance of me outperforming the markets quite often. So this is an important part of it. It's you establish that the market's in an uptrend, but as part of your analysis, and we'll get into this from a routines perspective as well, you determine what the leadership groups are in the market, and that your exposure that you have in the market should be reflective of what's leading the market higher, right? So those are usually not utility plays, usually not safety plays, usually not tobacco, usually not real estate or REITs. They're not those type of groups. They're the new things that are coming in the market where they're trading at a huge multiple. They're moving 30 to 50% in a shorter span of time. They will make a meaningful difference to your portfolio.
And I think a common follow-up question here, we talk about how important themes are. How do you identify the leading themes? We've done different webinars on that, but very, very quickly, you want to keep track every day and build an RS list and just a leadership list of what the strongest stocks are. And if 3 out of 10 of those are from cyber, that's probably an area that you want to be focused on. If, CrowdStrike is breaking out ahead of the market, that's a potential leader that you want to take a look at the other cyber names to see, are they supporting it? Oh, Okta is also breaking above a moving average. That gives, additional evidence, and we're really being detectives here. That gives additional evidence towards that theme could be a leadership theme. So you just want to pay attention every single day. What stocks are outperforming? What stocks are leading the market in terms of their cycles, individual cycles compared to the market? And that will point you towards the themes. And that's kind of a bottoms-up approach. You can also do a top-down approach. What ETFs are strongest? What ETFs have been performing the best over the past 20 days? You'll see semiconductors, if they're going to be a leadership group, they're going to be performing the best over the past 5 days, 20 days. And we have performance charts in DeepView that I take a look at every single day as part of my routine. And we'll talk about that in the routines webinar. That helps point me from a top-down approach. What are the developing themes as well as the existing themes in the market? Recently, before last week, really, miners were dominating everything because that was the dominant leading group. But as things change, very quickly, those performance charts can tell you where the puck is going, so you can identify these themes a little bit faster. But again, we'll dive a lot deeper into that in the screens and routines section, the screens and routines webinar. We talk about that in the book as well, how to identify themes. So more on that to come. All right, so here's an example of a very quick journal that you can do. Here, of course, is the date. Then we note down the trend day number based on if we're above or below a moving average. And then we have a quick note on the market action. And it can be as quick as this, wide rated inside day after a big extension, huge day on tariff pause. Again, what is the dominant fundamental factor that the market is caring about? And we're only caring about a fundamental factor because the market is reacting to news related to it. And that's what we note down here in the notes. You can also note down your RS list here. If you notice CrowdStrike acting best on this day, breaking above the 21 EMA when the market is still below it, that would be something to note down here, as well as, just overall thoughts on what themes are developing. But this is kind of a quick example. You've got the date, you've got the trend day number, and then quick notes about that day's action. We don't want to make it this huge thing where it gets so detailed that you won't do it. We want to be consistent. That's the most important thing. So you can connect your current state to past states and learn from past states, and use those as templates to go forward. Ryan, anything to add on journaling?
No, I mean, you're three things. One, the type of day it was in the markets, what happened, journaling that. I like to journal themes. So if I'm seeing divergence in, a particular group moving up while the market is in a down cycle, right? We had a 42 days down cycle into April 23rd, which turned into a positive cycle on April 24th, right? Now, this tells you the power of it right away, right? The last 42 days, if you spent time just, trying to time a bottom in the markets, you were highly unsuccessful. Or even if you did catch it, it was for a very short span of time, which would have left you, confused and dazed at the end of the day. So, having this and then knowing that, okay, the wind's about to turn, right around, I would say April 17 to April 22 area, we started to see decoupling in the markets, right? Market was down, stocks weren't down, etc. And then right before that, now we're starting to see some signs of an upside rally. Now, taking each of these days, noting down what's happening in terms of why it's happening. If it's news-based, that's the worst type of market because news can change on the fly, right? Rumors can fly all over the place. Someone said this, someone said that. Some news outlet puts this news out, etc. But then we get into that where, hey, the market's ignoring the news. The news does not matter anymore. Stocks matter more than the indexes themselves. Indexes are moving wild, but stocks are narrowing in their ranges on down days. Those observations will pile into, hey, I've seen this before, right? And I think, it's a good time that you'll start to anticipate the next move that the market's going to make, and it will make you a really, really good trader in terms of when you get into that performance phase eventually.
Yeah, and just based off these notes, you can, like Rai said, you can sense the shift. We start with an extension. This is how a lot of corrections end. We get a big extension down after we're already extended, a reversal back up, showing that the market's being supported there. It doesn't mean that's the time to act or the best risk-reward spot, but it's something that you're noticing and studying past market corrections. That's often how they end or the start of the end. Then we get a wide range inside day, still volatile, not really want to get involved yet. Then we get a huge up day on a tariff pause. Again, the thing that the market cared about, reversal, huge move back up. Then we get tightening action. We get a gap down, but then the market gets supported. We get more tightening action. We get a gap down again, but we close off lows. Then we get a gap up, positive expectation breaker, maybe a higher low is in. Then we continue to see additional confirmation, additional hints and bits of evidence that the trend is changing. And this shift all the way from April 7th to, when the trend really changed on April 24th, that's what you'll start to take into as inputs when you're stage 3 and even late stage 2 as, signs that, hey, I really want to get into my routine now. I really want to have a RS list so I'm ready when the market trend changes. So again, doesn't have to be too detailed, but it should be detailed enough that it gives you useful information when you look back on your notes as you jot them down. Phases of a market cycle. So we've kind of split it into these kind of different buckets. You could split this up as much as you want, but there's early uptrend, lots of uncertainty. The news will be negative, but the market ignores it. Maybe next week there's and we actually started to see this. There was frustration with the trade deal in China, which the market really cared about, but the market and leaders still acted well. So that's negative news that the market ignored or acted positively on. Market leaders early in an uptrend will be showing RS and beginning trends ahead of the market or with the market. They'll be bouncing strongly off lows. Then in the middle of the uptrend, they'll be start to see more positivity around the big news event that the market cares about at that time. News is resolving. Market leaders are trending. Secondary names are breaking out and starting their own trends. Laying the uptrend, we finally shifted from hesitancy and uncertainty to now strong optimism. News looks very promising, but at that same time, the market leaders, they've already been trending for quite some time. They'll lose steam, break down. Secondary names are still trending, but maybe showing signs of weakness as well. Maybe really speculative stuff is going crazy, laying the uptrend as well as, money rotates around. There's a lot more whipsaws, up and forth, volatility increases. These are all signs of late uptrends. Then early in a downtrend, news may still be positive, but the market acts negatively, or maybe there's a sharp new negative news event like more tariffs or something game changing again, and the market just really reacts and takes a negative stance on that. We saw that in December before all that chop. That really was created because the Fed came out and gave negative news again, and that is what the market really cares about. So you want to be aware of sharp negative news that can change everything, and just be aware that might change the market conditions. Market leaders early in a downtrend will be breaking down sharply, but the strongest ones might still be holding up a little bit, and it might kind of suck you in on a buy point when the overall market is breaking down. So that's something you have to be aware of. Volatility is going to increase. Then in the middle of a downtrend, news gets more negative. Rallies entice people in. There's still high volatility, still hard to manage risk. Then later in a downtrend, things get kind of exhausted to the downside. There's large swings, but not much further downward progress. New market leaders begin to show us, and that's when you want to start be paying attention so you can anticipate and be ready for a potential new uptrend. And just in general, an uptrend can last a lot longer than a downtrend. So a down cycle can be a lot quicker, a lot sharper as well. So that's something you're aware of. You want to protect yourself early on, but also you don't want to get too negative when we're already down 10, 15, 20%, because historically, if things resolve, things can shape up pretty quickly. And that's kind of the type of percentage loss, which can lead to a new uptrend. So, just in general, again, this is a lot faster and this can take a lot longer. Maybe this lasts months, maybe this lasts weeks. But of course, there can be a 2022 bear market, which lasts a lot longer than that. So take everything as it is, but you can always use historical precedents as a guideline for when to start, know when to pay attention a little bit more closely. Right. Anything you want to add on phases of a market cycle?
No, it goes hand in hand with journaling, and you'll notice these. The more you notice them, the better you will be at identifying them and looking for these things. You'll kind of know what the market's doing next. Most traders will tell you that when the market starts to ignore news, then it's more technical based, which basically means that liquidity is back. And when liquidity is back, range is narrow,
It's 12 o'clock.
volatility itself goes away, and it becomes a lot easier to trade. When we say it becomes a lot easier to trade, you can define your risk, you can define your entry areas, you could define which stocks and which groups in the market are acting well and where you want your exposure to be. in highly uncertain markets, it's really, really, really hard to put on, exposure where one day you might be up 14, 15%, and the next day you're down 7. That volatility is hard to deal with no matter how much experience you have in the market. And the most experienced people that you'll speak to in the markets are trying to avoid volatility or rash, moves to the upside or the downside. They just want a quiet period where the market's not in the news. The market's not based on one person saying something. The market's not based on tariffs and all these trade deals. The market's just trading on good, solid growth or certain industries that are going to double and triple in terms of revenue, sales, etc. Where that type of environment is a really healthy environment to really deploy a lot of capital instead of just putting on some feeler positions or nibblers or etc. Which is kind of just busy work, right? The real work happens when volatility dies down, news is not a factor, and things are just trending really well, regardless of what anyone or some is saying or trying to influence movement in the markets. So
Yeah, and that's another thing to add. And I mentioned volatility here, but there's going to be a lot of gap ups and gap downs during these downtrend periods. And in the early uptrend, we'll start to see less of that and more tightening action. And again, that's where we can manage risk, like Rye said, and that's when we can get more aggressive in the markets as well. So let's break it down a little bit into each of the different phases and how to trade them. So trading early in an uptrend, you can start taking positions when your cycle goes into an uptrend. Early on, breadth will expand. Stocks and positions should naturally build profits for you, and you can quickly use progressive exposure to scale up, or depending on your stage. I know, Rye, you want to talk about this a little bit. Stage 1, 2 traders, it's a lot different than when you've got that intuition stage 3, stage 4 in terms of using progressive exposure to scale up versus becoming more aggressive earlier on. So, Rye, do you want to expand on that concept?
yeah, so trading early in the uptrend. So what happens is essentially, let's say the market is down, stocks are going down, we're seeing a trend reversal. That initial trend reversal and those initial days, the day 1, 2, and 3, is when you're supposed to be positioning yourself, because all the homework that you've done, right? How does a downtrend end? We see stocks start to ignore news. Stocks trade on their own merit. Market is down, but the stocks are not going down anymore, right? So that evidence builds as you're in that downtrend. And then when the market cycle triggers to the upside, you should know your leadership group. You should know a list of stocks that are exhibiting relative strength. And when the market's in an uptrend, it's time to act, right? It's not time to collect information. It's time to use the information that you collected near the end of a downtrend to then deploy capital on day 1, 2, and 3. Those are the best days to deploy it. Those are the best days to put on exposure. Those are the best days to make really meaningful progress right away that puts you in the driver's seat. Once you're in the driver's seat, you got to dictate when there's a stress test on day 5. You'll be sitting there and watching the markets because you're in a good position. You've put on 45%, 50%, 60% exposure, and you're trying to get to 100%, right? Whereas the trader that is noticing the trend at day 4, 5, and 6 is going to encounter that stress test, and it's going to flush them out of the market again because they are a little bit late to the game. They didn't interpret that, the decoupling action or stocks ignoring the news or stocks not going down when the Nasdaq's down 2%. So early in the trend matters. Good positioning, like Ross says, if you're not buying right, you're just buying at a spot that puts you in a bad place for you to get stopped out, right? So it's super important, and the market cycle helps you do this, right? It helps you identify themes. It helps you identify which stocks are about to, turn. Helps you identify that the market's not news-based anymore. I can't emphasize this enough. A lot of traders get in the game too late, just in time for that stress test. The stress test flushes them out. They're still in cash. The market rallies back up. By the time they get in again, another stress test, they're flushed out again. And the whole uptrend, initial uptrend, the 10, 12 days, they're just out of the market. Where they're supposed to have heavy exposure, they're kind of, one step behind. And when you're one step behind, there are many things and many excuses I've heard over the years, talking to thousands of traders from the market, is after me. They're hitting my stops. They're placing, they're pushing me out and then rallying. They. There is no they. You're just a little bit late to the game because you don't have a market cycle system, right? So.
And you mentioned decoupling action there. Define that for people. What is decoupling action?
Decoupling is essentially when the stocks that trade within the market don't care about the influence of index-based action upon them, right? In a downtrend, what happens is when a market is moving down 10 or 15%, it doesn't matter if you're the best company in the world, you have the best sales, you have the best earnings, you have the best fundamentals, you've released a new product, you've put out a PR. If the market's in a downtrend, you're going to get trashed, right? But what happens is right when that downtrend is about to shift from a market perspective, stocks start to kind of sniff that. They kind of have that, sense or ability. And, institutions come into the right ones and they start accumulating those. And that accumulation results in relative strength. And that accumulation results in decoupling. So what will happen is there will be a couple of days, and this happened this April as well, recently, where the NASDAQ or the SPY will be down from an index perspective, will be down a lot. And what will happen is the stock that you're looking at, Palantir, Hood, Netflix, and all of these recent ones, they did not care about the market anymore, right? And those were the days, you're seeing a stress test in the market, but the stocks are not equating, I expected Hood to be down 4%, 5%. It was flat on the day, holding that $40 level, right? Continuously tracking why is this holding this level when the market's, pulling back in? Why is it doing that? Why is it doing that? And it went from 40 to 50 in 3 days, right? So that's what decoupling is. Stocks ignoring market action, basically stocks ignoring news, right? And trading on their own merit. When they trade on their own merit, it's a lot easier. You can define levels, you can define risk, you know where you're getting in, you know where you're getting out. When if it's index-based, you have to wait overnight. What is China going to do? What is this company going to say? What is, what news cycle is going to run overnight? Where is the index even going to open, right? Open down 3%, 5%, 10%. You don't know. But once all of that's kind of gone and stocks are just trading on their, is it a good company? Does it have the good fundamentals? Is it increasing revenue and sales? Is it the first positive EPS quarter they've ever seen? It becomes a lot easier, right, to trade.
Perfect. So getting more into progressive exposure, and again, this is more for those who really need structure, stage 1, 2 traders. You want to listen to your trade feedback. You can scale up, scale down depending on that feedback. Start with 1/2 positions when we begin a new market cycle. Quickly go to full if they make progress. You can always think of it in terms of total risk. How much are you willing to risk to try this new uptrend? Are you willing to risk 2% of your account to potentially gain 5, 10, 20% in a strong uptrend? That's kind of the question you need to ask yourself. And I've got some quick math stuff, some hypotheticals here to try to help explain progressive exposure and how to think about it, especially for shorter term, more beginning traders, to kind of show the math behind it and how you can manage your risk. So bear with me. You might have to rewatch this a few times to really internalize it. But let's say a market cycle begins. You decide that you're willing to risk that 2% across a few trades to see how this trend does. So you risk 2% across 4 potential leaders that have shown consistent RS. You've been doing your journaling. You've identified them. They're the CrowdStrike, PLTR, Tesla of that cycle potentially. So you have 4 10% positions. Again, this is for more beginning traders with an average of 5% stops. I like to keep it a little bit tighter, but we're using 5% for this example. You could also use 20% positions with 3% stops and get pretty much the same risk profile here. Eventually, 3 work and gave an average of 4% for you. So you're at 4% profit on average for 3 out of the 4 positions you tried, but 1 stops you out. What's the math behind this? What's your portfolio difference? The result is a loss of 0.5% plus a gain of 1.2% of your account. Because again, 3 positions are working for you. They gain on average 4%. So on net, you have 0.7% equity increase and positive feedback. The 3 out of 4 of your trades that you tried worked, so you have positive feedback. The next day, because you've got that positive trade feedback, you're going to try 3 more trades on 3 different market leaders, or maybe even one of them is one of the stocks that stopped you out and is still set up overall, but just stopped you out. and you're increasing your position size slightly because you're getting that positive feedback. And you want to do this quickly over those first few days of a market cycle. So you try 3 more trades at 15% positions with 4% stops, around 1.5% more equity risk. And now you're at 75% exposure because you have 3 stocks at 10% exposure and then 3 more stocks at 15%, which in total is 45%. So 45% plus 30%. Out of these 3 more trades, 2 out of 3 work and rise 5% for you, and 1 stops you out. So trying to be realistic here. The 3 original positions also rise an additional 3% each. So those are still making profit for you. What's the result? You have 3 stocks that are now up 7% on average, and you have 2 stocks that were 15% position sizes that rose 5%. That's this 1.05. And then you have 1 stock that was 15% size that declined 4%. So net, you're up now, you're day 2 of the market cycle, and you're up 3% in your equity curve, and you currently have about 60% exposure. So still room to increase that if the trend keeps working. But this is kind of a realistic way that you might, build exposure and build core positions. And then later on, you look to add at logical spots, add new positions as they continue to break out, because in the first few weeks of a market cycle, that's when new leaders will be continuing to break out. So this is kind of a good example, and hopefully this makes sense to you. And again, you might have to revisit this, rewatch my explanation, and maybe do the math for yourself as well about the different position sizes, what profits you have on them. But this is showing the math behind progressive exposure and how taking stops and listening to market feedback can change how you trade and how aggressive you are early in an uptrend. So that's a positive case. Obviously, you've got a pretty good batting average. You've timed it pretty correctly. You've looked at the right stocks and identified those. It's not going to be all as rosy as that all the time. So what if we reverse lower instead of taking all the stops on those first few positions as well as those additional 15% positions? Well, you had 30% at flat. Basically, there's no gain on those because you'd raise your stops to break even. And then on those 15% positions, you lost 5% each. So you do have a 2.3 equity loss, and likely the market is rolling over. We had a stress test that then really led to additional move lower in the market and stopped you all out. And you do have a 2.3 equity loss, but that's part of the game. You've listed on a day 2.3% is easily recoverable when when a new uptrend starts again. So what if you had moved your stops up to original positions to 2% in the money instead? Well, instead of being flat on those, you'd be up 2%, and then the same decline on those 3 additional, and you'd have a 1.7% equity loss. So you're still losing money, but losing less money. But if you had moved up stops on original positions and new positions when they rose 5%, you'd have a gain of 2% on those 10% positions, and we're flat on the remaining. And basically, this is equity gain here, not loss. You'd have a 0.7% equity gain and a guaranteed higher low on your equity curve. So this is how you can move your stop loss up as stuff makes progress for you early in a trend to guarantee a higher low on your equity curve. So early in a cycle, you need to add total open risk to participate in a rally, but you can manage it by looking for positive trade feedback, position sizing, and adjusting stops to manage that risk. Right, anything you want to add on progressive exposure or kind of the math behind guaranteeing a higher low on your equity curve?
It's quite important because when you're beginning, you're putting on too much, and what happens is when you put on too much and you get that negative feedback, it sways your equity curve way too much, which results in bad information, and you get a lot more cautious when you're supposed to keep pressing, right? So it's a really important concept, especially for phase 1 and 2 traders. I think phase 4 and later part, when you're consistent, it matters a lot. I would say less because you develop a feel more than having a mechanical system that works for you. But it's super important to pay attention to early because it gets you out, right? If your first few aren't working, that means you're either in the wrong space or what you're doing is not working. Or if your first few are working, you develop that confidence a lot quicker, right? The second thing it does is, position sizing. It keeps that in check and in line with what you can handle in terms of risk, right? The main problem with stage 1, 2 traders is they're putting on too much risk. They can't handle that risk. So when they see that down, pullback or that down day, they're not able to handle or stomach that day, and then they make an irrational decision when they're just not there yet, right? So it does those two things for you, and it's super important, I would say.
Yeah, and I like the comment from Paul. Richard probably made all A's in his math classes in school. Well, I was a mechanical engineer, so I had to do differential equations and stuff like that. And Ryan's even smarter than me. So, one other thing I want to mention here is a lot of top traders who I just interview. They also use ETFs, leverage ETFs to gain exposure when everything is correlated. Because when everything is bouncing and starting a new uptrend, a lot of stuff is moving together, and leverage ETFs can be a great way to quickly gain exposure when the leadership is a little bit unclear, or they're not quite at spots where you can manage risks exactly, but a trend is starting. So you can use a 2x or 3x index ETF like the TQQQ to build exposure. So another example here, 20% position in TQQQ with a 4% stop is less than 1% account risk. But if it makes progress for you as the uptrend develops and say rises 6%, which could be honestly just one good day in the market, you end up having a 1.2% equity gain, which then you could sell and finance 3 trades on a CrowdStrike, a PLTR, when they actually set up spots where you can manage risk. So this can be another good way to gain that initial exposure that then you can risk that profit to finance trades and build into new positions to early in an uptrend.
It's also a really good way to I'd say use what we said in terms of extremes, like the percent of stocks above 40 MA and things of that nature. If you really backtest those really well, index exposure initially is usually a good way to go about it. It keeps you, you don't have to pick the best stock yet because you don't know what the best stock is going to be at extremes, right? So it's a really good way to get started. And even in the initial, this downtrend and then that rally up 12%, one of my first positions was to actually spy, right? And getting exposure. I didn't go 3 times. I went the options route, which I don't want to kind of mention here because there will be like a ton of other questions why. But it was index exposure. And then as that started working, we were at really extremes on all levels. Any breadth metric that you took would say, hey, this is historically, we're supposed to bounce from a technical area, right? So instead of picking a name, I pick, this is a really good way. I think we have a couple of podcasts, right? With Viva is a good one for you to look at. She uses the TQQQ quite a bit to time market cycles. It's a good way to get exposure. And then, it's one of my favorite, recent things that I've studied and kind of incorporated in my approach.
Yeah, so this might be a golden nugget that you guys take away from this webinar. And another golden nugget that I want to point out is the decoupling explanation that Rye did. Make sure you go back and rewatch that because that is so key in terms of learning to anticipate market cycles and anticipate what stocks could be the next leaders. So definitely pay attention to that. So again, just to summarize, early in an uptrend, the goal is to gain exposure to top liquid ideas to test the uptrend, listen to trade feedback, and manage open risk. Early in a cycle, there'll be a lot of noise, uncertainty, news events. This is why we need a system to define our actions and then let the market show us what to do. So gap ups, breakouts, all of these will be doubted. Trust your system and risk management process. Build that exposure, listen to feedback, and that's all you need to get exposed and be way ahead of the curve with everybody else. And then here, I just want to mention, there is a window of opportunity after a significant correction like the one we're currently in. The best ideas might not break out until next week or the week after that even. So as the uptrend sets up, leaders will be breaking out slightly before it and in the weeks after that. The strongest will move before the market, but there will be opportunities over the first few weeks of a new uptrend. Stage 1, 2 traders should strictly wait for their cycle to act to avoid the chop that, the volatility. You're not yet equipped with the technique to deal with that. So it's more for the stage 3, stage 4 traders especially to maybe anticipate a change in the cycle and look to position a little bit earlier in the top ideas that are showing RS and setting up. But yeah, stage 3 and 4 traders can anticipate a little bit more. Then here, and I've got it on the next slide, this was from a Trade Lab markup that I did many months ago of a bottom of a prior correction. This was back in 2023, I believe. Yeah, 2023. And you can see I've labeled when there were significant moves in leadership names. So DEC, INTC moved, 2 days off the bottom, then now broke out. Then CMG pins acted well. Then you see a lot of them on this gap up day. And then you see how continuously new names pop up and either reconfirm breakout of new pivots, reclaim moving averages. So this kind of just shows you what you want to see in a new uptrend in terms of names gaining exposure and making profits for you. But also that, if you missed now, you could have caught Affirm, Coin, Crowd, Cyber, Dash here. So don't feel pressured that, I missed MSTR. It went without me. It's up 40% now. There's going to be a name that could go up 30% or even more than MSTR later on. But you want to be focused during these first few days, so you're identifying them early, so you're ready to take advantage of these opportunities. But I think this is a really good example to show you how things shape up early in a new uptrend. And then this is an example of labeling, the current environment. And there's going to be new names that pop up if this trend really takes hold, which we'll see what happens. But here on this day, if you look at charts, there are many oops reversals and undercuts and rallies of potential double bottoms. Then on the reconfirmation day, everything reclaimed the 21 EMA. Lore broke out of a base. PLTR reclaimed its 21 EMA. So you'll see the leaders act better earlier. But as we get further on in this rally, more and more names are acting well. MSTR, Gap and Go, TTWO, base breakout, GEV, range breakout, Hood, range breakout, ZS, range breakout. Tesla just broke out yesterday, which was, 10 days, 15 days off the lows, but it's now just moving at an actionable spot on Friday. Okta popped through its 50 SMA. So you'll see this expansion in leadership and names if the rally really holds. And on purpose, I included up here where Tesla and PLTR actually had range breakouts on March 24th, if I remember correctly, that then ended up failing. And that's part of trading. Maybe in hindsight, you could recognize that this correction was just in its first leg down and needed more. But even if you tried that, you could have easily managed your risk and gotten out with a paper cut if you're trying it in this area, because things were setting up potentially for a market rally. But then we had a rejection down, and really expanded to the downside. But they did have range breakouts here, but that's what you kind of want to be looking out for early on to identify RS early, is what stocks are leading the cycle, what stocks are forming, higher lows as this market put in a lower low. If you take a look at the Tesla chart in particular, yes, it failed this breakout, but if you look at the Tesla chart, and maybe we have one later on, but it didn't really violate this relative low. It really just chopped sideways until last week, where it gapped up, even with the gap down on earnings, which everybody said was the most negative earnings report they've ever seen. So look for stocks that aren't really forming lower lows when the market's forming its lower lows, and that will help. That's a golden nugget to help spot that RS. Right. Anything you want to add on either of those slides or the window of opportunity when an uptrend begins?
Yeah, there's going to be plenty of it. If you're not, you don't have any exposure. I know traders are still cash waiting, etc. It's fine. Learn to go back and see what happened on Hood, ZS, Netflix, Tesla, Okta, and some of these that Richard's pointed out. These are really good, a good diagram to study. And this is all part of the market cycle, right? When you're actually journaling, and if you were to do this, Minervini posts really similar charts of like, hey, this is what happened in a current market cycle, and how how I put on positions. So just doing this or doing it in a journal format will be immensely, good for your trading. And the more you do this, the better you'll get at it.
Yep. All right. So trading later uptrend, I like to focus more on less obvious buy points, pullbacks in the leaders versus breakouts in secondary names or names that aren't really part of a leadership group. Overall, later in uptrends. So if we've been trending for a month and a half, 2 months, doing less, letting the core positions work for you as long as they're trending, acts well. What does late mean? Just that we've been extended in an uptrend. Everybody kind of knows we're in an uptrend currently. Maybe we've been making new highs for many months. Doesn't mean it can't continue, but you just want to recognize that the reward isn't quite where it was beforehand. Nvidia has already moved 80% in this uptrend. How much does it have left before it needs a natural pullback? That's kind of the judgment call you need to make in terms of identifying a late uptrend versus a middle uptrend versus an early uptrend. And then you don't want to get over your skis again. Like I said earlier, position sizing shouldn't be quite as aggressive because risk is increased or potential reward is decreased as we get later in the cycle. Right? Anything you want to add on
Yeah,
on,
and
on this concept?
usually when you do the market cycle count and you have a journal and you're in that 40 to 60 range, right? And if you take any market cycle in the past or now, what will happen is if let's say we're running into earnings season and the market cycle is at plus 40 or plus 50, those gap ups are going to get sold into. It's just the nature of the market. There's a risk on environment coming into earnings season, and it's highly unlikely that the market will, provide new setups that have extremely high potential, and that those gap ups are used to kind of sell stock and build new bases. That's happened with the recent earnings cycle. If you pull up ABP, right, it gapped up very late stage in its run. It was up over 400% going into that earnings. The market cycle was also extremely, we had a 30, 40-day uptrend already. And that's what we mean by, if you're putting your biggest positions on at that point in time, your equity curve is going to suffer, right? That loss that was supposed to be minimal, even if you were to try to get into a gapper, and you put on the wrong position size and we're later into that uptrend, plus 40, plus 50 days in terms of market cycle, your math is not against you, like it's not with you anymore, right? And you're literally mathematically putting yourself in a position to fail. So recognizing these moments, right? If we've already had a healthy uptrend, it's highly likely that the gap ups are not going to work. If you still want to be involved in them, position size lower. You've already made progress. You want that higher low, right, on your equity curve. You want to make progress from bottom left to top right. And to do that, you need math to be on your side. And a lot of traders do the opposite, right? We get into that euphoric state where any company, anything, any, thing with .ai is moving, and you're putting on extreme position sizes or quantum names, right? Quantum names, if you pull up any of those, that was extreme, movement. They had, all it took was one CEO saying it's 15 to 20 years away. And overnight, you got 30%, declines in those type of names. That was late in the market cycle. So if you put on extreme position sizes late in the market cycle and you got caught in those, you will give back significant amount of your progress the first 30 days where you worked so hard and you did everything right, only for that last step to fail and you kind of ruin your equity curve. So
Yeah, and it goes a little bit back to that comic that we showed earlier on, where early in a trend, breakouts, gap ups, they're all doubted, and it's institutions buying and creating those gap ups, and they're more aggressive in their accumulation. That's why they work. Later in a trend, the institutions already really have their positions, and they're maybe looking to take some risk off on a gap up and sell into strength. And in the middle of the trend, the breakouts that are working aren't the prime ones, and it's more the pullbacks that nobody is looking at that are the best risk reward opportunity, and the leaders that already made an initial move up, pulled back, and now is reconfirming. So that's kind of how you want to think about it. And again, understand where you are in the cycle and what is the best risk reward type setup to suit that part of the cycle. I think that's a key thing to take away from this is different setups are going to work best where you are in that cycle, how far along we are. And you want to treat, like Rai said, a gap up later in the cycle a lot different than you would an earnings gapper out of a first stage base when the overall market is just recovering from a correction, versus when the stock is already up 300% in 6 months, and everybody's talking about it already on Twitter. Who's left to buy? So I think that's some good concepts here. Trading early in a downtrend, I like to cut my weakest positions early. If you short, this is the best time to be like early in an uptrend for going long. This is the best time early in a downtrend to go short in order to benefit from the expansion down. Treat trending positions on their own merit. Early in a downtrend when it's a little bit unclear whether we're starting a downtrend versus just pausing or consolidating before we continue the uptrend, I treat trending positions on their own merit, especially if I have a 30% cushion, 40% cushion, and we're still holding above the moving averages. Until it really breaks down, I'll look to hold that position, or at least the core part of my position. And then look for short covering rallies, SCRs, around day 5, 6, day 10, 12, just like the stress test days. Watch out for these big rallies. And if you're short, really be on the lookout and be more biased towards covering into weakness, to lock in those profits on shorts when you're starting to anticipate that these can occur, because these can be really vicious, and even more vicious than the stress test days even. Right. Anything you want to add about trading early in a downtrend?
Yeah, use that, once we're in that, be cautious with your positions. Definitely no new exposure. That's the biggest thing. Don't try to time that the market's going to reverse. If the market's going to reverse, it's going to trigger a positive market cycle for whichever system that you define. So wait for that. I would say those short covering rally days can be really, people get a little too enthusiastic. But with the market cycle system, if you look at the 5, 10, we have this indicator in deep view, you'll see the dots appear exactly when we're about to rally, because we sell off, right? And the market just can't just sell off like straight down. So it needs to rally a little bit. Folks, enter. There's resistance areas that form technically as well. They run into those and then we fade, right? So those days are not really days to go along. They're days to see if anything comes off of those days. Is there follow through after those days? Is there sideways action? Are stocks actually, most stocks will actually, when the market's rallying, it's up 2%. A growth stock will only be up 2%. That's a clear tell that, stocks are just following market action. They're not really trading by themselves just yet, right? But then when the market's down 3%, they're moving down 6%, right? So this is another part of it. The most important one is to get out the way, right? When the market cycle is negative, don't place new positions. Watch your existing positions.
Yeah, stage 1 and 2 traders, it should just be trying to go flat in your equity curve when the market enters a downtrend. I think that's the ultimate goal, is not give too much off the top and just try to go flat and wait for the next uptrend. Even advanced traders, talking to Oliver, he doesn't do much shorting because he hasn't really seen the benefit too much in terms of equity curve. It's faster. You have to take profits a little bit, a little bit quicker. So, I like I said, the ultimate goal is to not lose too much during a downtrend. That's the goal. Trading late in a downtrend. Downtrends are typically shorter in duration than uptrends. You want to sell short positions into strength, cover into weakness. Monitor for relative strength. Like we said, build RS lists. Look for themes that are setting up together. As Ross says, look for overall groups that are building launchpad setups together and moving up the right-hand side of the bases. Look for stocks leading the market cycle and watch for potential uptrends and upcycles and watch for developing leaders. That's the key thing. And it's amazing how quickly charts can shape up. And that's why it's really important to be in tune with your market cycle and almost anticipate when things are shaping up so you can be ready. You've got your homework done. You've got your RS list. You know the themes you want to focus on. 3 to 4 leaders that you want to be your focus and would be your first initial positions if the market does start uptrend. All that homework is so important to be done in when we're late in a downtrend, so you're ready for when we start an early uptrend. Quick note on building RS list. How do you do that? For me, each day I run a general screen. DeepView leader screen is my go-to. And I note stocks showing consistent RS, not just showing RS on one day and never showing it again. I'm looking for stocks that again and again are appearing and standing out on my screens. I like to sort that screen by daily closing range, percent change from the open, 1 month absolute strength, percent change over the past X days. If the market, for instance, bottomed 15 days ago, I like to create in DeepView a column that is percent change over the past 15 days. So I can sort by that from highest to lowest and see what stocks bounced the fastest over the past 15 days. If it bottomed 10 days ago, I do the same thing with 10 days. And that's amazing at spotting the PLTRs, the CrowdStrikes that have rallied strongly since that bottom. So these are a few different ways to sort your screens to find RS. And then look for stocks and themes that are up or holding well when the market is down big. Holding above moving averages like the 200 SMA when the market is well below it, forming higher lows as the market forms lower lows, consolidating sideways as the market trends down, bouncing the strongest off the lows, like I mentioned, reclaiming key levels like base lows or moving averages first, breaking out first through levels, highs, all-time highs. We saw Netflix break out when the market is still well off highs, and just entering RS phases. I think this is a great way to look at it too, is add a DFU relative strength line to your charts. Look for stocks that enter an RS phase in that. And that's a great stock to be focused on as it's shaping up, taking into account the overall context. And then also just in general, I like focusing on stocks that are closer to all-time highs. And, CrowdStrike is pretty close. PLTL are pretty close. But, there are situations where the next market leader is well off highs. Like Tesla is a liquid name, a liquid leader that has been consolidating for months now. So it's well off highs. That doesn't mean it can't lead again. Just that's another factor that I'm taking into account, and might judge the quality of one stock differently versus another. Right? Anything you want to add on building RS lists?
I think it's part of your journaling of your market cycle, right? Especially in downtrends. The only way for you to know which themes are developing, which stocks are about to move the most, and which sectors or industries of the market are going to lead the trend or lead the market out of this downtrend is for you to build relative strength lists. There are many different ways to do it. It could be the 52-week high screen, as simple as that, right? It could be stocks that are not making a new low when the market's making a new low, right? A simple one that Richard pointed out is the 1 month AS or the absolute strength rating, which just tells you what are the top stocks in the market right now, and that will continuously list updates every single day. But find a way to look for stocks that are starting to ignore market action. As the sooner you do that, the best ones will do that. Netflix did it, PLTR did it, Hood, anything that you look at right now that is up or away from their initial pivots did that before the market turned itself around as well. So it's an essential way for you to identify themes in the market, which names and the setups that are forming as well. Also helps you identify levels, right? For me, Hood was like the 40 level. I was super focused. Like I want to trade this name. It's showing me the signs. I will double down on it and just focus on this one because it's showing everything that I look for, especially in downtrends. And all it takes is that one or two stocks to really make a meaningful difference. So build those RS lists. Sometimes I would say it gets frustrating. We've had 60-day down cycles, which is quite a bit of time in the markets, but you still have to consistently look at the markets and build them, continuously document what you're seeing, and that's how you become consistent. A lot of traders want to know, hey, after minus 60 days, it turns into that first market cycle day. They want to know on that day one what they're supposed to be buying, right? That their research starts on day one. That is how you fall a step behind, right? Your research should be during that down cycle, what formed the best basis. So when you're in that uptrend, that first day, if you don't know what you're buying on that first day, you're behind. You didn't do your homework. You're not going to be on the right side of the market. You're missing that initial breath, where everything kind of goes up at once. One, you will not be in the best names, which you're supposed to be in, because that's the downtrends are to see which names are going to lead the next uptrend, right? And you're not exposing, you have to deploy capital on that first day. You have to deploy capital on that second day, so that by the time we get to that stress test, you're just looking at what's happening in the markets. A lot of traders just miss this. It's like a pivotal step, and then the whole uptrend they're complaining. And when you're complaining, you're not doing your homework. That's what it kind of shows me at the end of the day. So build them, document them. The more you document with that journal, you'll just build intuition and see time and experience, and all will kind of mesh itself together into a really great system.
Yeah, doing this work during a correction will allow you to know exactly what you're going to do, what names you're going to enter, and enter as the cycle's starting, so you're in and you're benefiting from the Zweig breath thrust thing, which is a great indicator. But again, it might be too late for the system and your goals in the market. And I'm not knocking that. I'm just using it as an example for sure. So here's our RS example. This is PLTR. Note how it entered an RS phase on this day right here, and then it set up in a gap. And I actually tried it this day and the next day and got stopped out, but it re-entered on the 21 EMA pullback. So again, you're going to get stopped out, but then you want to benefit from when it sets up again and breaks through the pivots again. And throughout this, it held well above the 200-day moving average when the market was well below it. Big undercut, big move off lows, strong close on this day when the market faded a lot more off highs and had a pouring closing range. There's a lot of elements of relative strength to this name, and just point to the fact that this could be a leader in the next uptrend, and a leader that you want to be focused on when a new uptrend starts and really takes hold, like we've seen the past 3 days, where it's expanded from 100 to 115, pretty much 15% in just a few days. You want to benefit from that expansion. Right, anything you want to point out on chart of PLTR before we move on to the next example?
No, I mean relative strength. So what I made your RS list, relative strength is an edge, right? The setup is there in terms of entry tactic. It's tightening its ranges. The volume was low in that consolidation as well, if you look at the volume at the bottom. And then when it moves, we had that expectation breaker day where it was like, hey, I expected the market to go and open down. It opened in the wick, closed up, right? Mm-hmm. That was like, okay, this is something that the market can build off of, leave a lot of, people behind, and then rally off of it as well until people kind of, catch up for that. So next week, I'm anticipating Tuesday, Wednesday, we'll start to see some pullback, right? Where we'll see a steeper one, and then we'll kind of see, okay, which ones are the true leaders? Which ones just rallied initially? What do the positions that I hold, are they acting well or they're not acting well, right? Is this segment of the market, what are the leadership groups? That's going to play out over the next week and a half here, where things are going to get fleshed out. That diagram that Richard shared where this stock broke out, that broke out, that's going to start populating a lot more. There are going to be more setups that if the market's, going into this larger uptrend or reversing higher and has made it its low already, we're going to start to see those things play out. Everything that we spoke about today. So,
yep, perfect. And then market gauges. Ryan, you want to take this?
So market gauges is essentially, every market is led by a particular, few stocks that will be of focus from most, the most amount of participants in the market will focus on that. A good example of that recently or in recent years has been NVIDIA, right? Netflix when it was, back in 2020, 2018 area. Facebook was another one, right? Huge uptrend. So market gauges essentially is a concept where you're looking at what are the top names in the market, what are they doing, because they will dictate what kind of happens to everything else, right? So I like to see, is, for example, next week, if Tesla breaks this 300 level, is a level I'm interested in, and going forward, if Tesla is trading above 300, for me that's a mental check that, hey, the market's still good, right? Or if Netflix is holding that 550 and it continuously trades above that 550, the market is supposed to be okay, right? So it's a market gauge. So you take those top names that are breaking out and leading, where Ross says watch the leaders, and you're looking at really particular. I like to look at whole number levels, right? So if 550 on Netflix, 300 on Tesla, X on PLTR, if these are holding, there's nothing to be concerned about. Risk appetite's still good. We're early in an uptrend. They're holding the levels they're supposed to hold. And for me, in the back of that, it's like a mental, checklist that if these stocks are holding, the market has a chance, right? And especially on stress test days, it becomes really tough. Your conviction is tested. The positions that you hold are coming down, and you're trying to interpret what the market's going to do next. And if your market gauges are holding those key levels, there's nothing to be bearish about or concerned about just yet. But if they're breaking all those key levels on a day where you're having that stress test, then you switch and you pivot and you say, okay, it's time to play defense because the market's doing a little too much in terms of a pullback, and my market gauges are not acting too well. The top ones that are leading the markets are also suffering quite a bit. That's when you go, okay, I got to step back, play some good defense. here and see what the market does thereafter. So that's a concept of market gauge. I think Richard, you have a few examples.
Yeah, I've got some examples, and just to summarize it, Ross has really ingrained this in our heads, and he teaches this in every webinar he mentions. Almost watch the leaders. Identifying the leadership and judging how they are acting will give you a huge tell, again, to what Ryan mentioned about the risk appetite and risk profile of the market currently. And watching the leaders will give you that evidence beforehand. I've got some examples here. Just this recent correction. This is the QQQ on the bottom. Here is PLTR in the middle, and then Reddit at the top. And Reddit and PLTR were really the strongest growth names, growth leaders during this time of the market. Nvidia had already topped, MSTR had already topped. We'll show that in the next slide. But these broke, gap down to the 21 EMA, resolve lower. Not gap down, but strong reversal down, breaking many lows at all before, this is all lined up in time, before the QQQ really started breaking down. So watching these leaders will give you that tell a few days before the market really reacts significantly. So that's why it's so important to watch them very, very carefully. And then here's the next slide with MSTR and Nvidia. These were some of the strongest names during their trends, but big downside reversal, big reversal here leads all to this chop, trending below moving averages. And now MSTR is potentially leading the way again. Nvidia popping above its 21 EMA again. But this gave you a little bit heads up about the choppiness that we might expect in December. So watching these leaners, the top 5 names, Oliver Kell also watches Google, Meta, Tesla, the big liquid names that the institutions have to own. Those names, watching the true market leaders as well as the just very liquid leaders, are going to give you very valuable information about the risk appetite of institutions and the overall risk profile of the market. So this is a really key concept that you want to internalize and maybe make it part of your daily, weekly routine, as I've done, to take a look at their trends. Are they above their moving averages, below? Are they gapping up, gapping down, reversal? Are they extended? Are they breaking below moving averages? Take all that into account and internalize that, and that will help you identify, again, the health of the market. Ryan, anything else you want to add on market gauges before we close that section?
No.
Awesome. Well, we'll take a quick pause for Q&A. And I want to do a pretty special Q&A, actually giveaway here, of one of my author copies of the handbook. Now, to join this giveaway, you have to have already pre-ordered, and I want in the chat, this is going to be your entry to the giveaway. Mention your biggest takeaway so far from today's webinar, and you can't just say 2 words. You have to explain the concept or explain why it was the biggest giveaway. And I'm going to pick the third mention here. So let's see. Let's see what you guys say. And if you're watching the recording, I'll be giving away 1 more author copy. So do the same thing. Drop in the comments below what your biggest takeaway, biggest concept has been. And you'll be selected your winner. And just email me at richard@traderline and we'll get you hooked up. All right. So who is the first? We'll do first and third. Do RS studies before market turn. That's good. So Pat, I've selected you. Awesome. Congratulations. And then Sven kind of said the same thing. Market gauges. So Mari and Pat, you guys have won author copies. So not just special copies, author copies. I'll sign them as well. Email me at richard@traderline.com and we'll get all that set up. All right. Great job, guys. And then also drop in the comments any questions you guys have so far about today's webinar.
Richard, I'll be hopping off. You can take it. I got to step away. But,
Sure.
Definitely enjoyed this topic. Is quite important. If you guys have any questions, definitely if you're watching this after the fact, put them in the comments of the YouTube stream as well. We're always taking a look at those and making sure those always get answered as well.
Yep.
Apologize that I have to hop off midway, but there's the second half that Richard will go over popular market cycles.
stick with me. I gotta reorganize the overlay a little bit, but Rye, yeah, go ahead and drop off. But we still got a lot of great stuff to cover, guys. So stick with us.
Thanks.
So go ahead, Rye.
Thanks.
All right, guys. So drop those questions in. I'll answer a few here. All right. Great tip was to watch the leaders not being down on the market in down days for sure. Big sign of relative strength. Use of journal, nice Edward. Leverage ETFs, nice Paul. Very nice. Yeah, Jose, we'll send a webinar with all, an email with all the webinar links. Right now, we're creating a playlist on YouTube with everything. So it is all in one place. And for those who order the book, you'll be able to access all the resources, no ads, anything like that, all in one place on our website too for free. You just have to submit proof of purchase, and we'll be organizing that later. But more on that later on. Scott says you use the 21 EMA as your market gauge. What about when below 50-day and 200-day? Caution or proceed, the scale and or. I prefer 21 EMA when we're above the 200 SMA and 50 SMA, but I will still trade because my market cycle is defined by the 21 EMA when we are below it. I just recognize that, it might be more of a short covering rally that might last a few weeks versus, month-long thing. Biggest takeaway, asymmetric beta, 100%. All right. Perfect, guys. All right, let's keep on going. So getting into some popular market cycle systems, this should kind of give you guys ideas as you guys are defining your own. So first, this is a market cycle system, Stan Weinstein stage analysis system. It is more longer term and is maybe more suited for active investors or longer term position traders. But this is 100% a market cycle system that defines uptrends, chop, downtrends, all of that. And as a filter, I use this in the back of my mind in terms of the longer term trend. I want to be trading with the longer term trend when I'm using my kind of shorter term cycle within the context of this longer term cycle. And this will get you out of the worst bear markets early on. This will get you into the bull markets as well, the new stage 2 uptrends. So this is 100% an excellent market cycle system. Here is the stage analysis system. In DeepView, we've got the stage analysis indicator that plots the stage 4 in red and the stage 2 in green. So you can kind of see how it's applied in real life here on the QQQ, starting in 2021 into 2022 with the bear market, and then into the new bull market, which just recently ended. And we'll see if we can start a new stage 2 uptrend at some point. But right now we are below the key moving averages right here. Then the cancel and falter day is another excellent market cycle system. It's defined by looking for after a rally has been established, a big up move on volume greater than the previous day, and the percentage change on that day is a little bit different depending on the volatility of the market. But you want a considerable move. You want to see leaders also breaking out. You want the qualitative factors in addition to the quantitative factors, and a percent change of 1.25, 1.5% depending on the market is kind of what you're looking for. And you don't really want to be in doubt. I see a lot of people asking, was this a follow through day? You don't really want it to be a doubt. You want it to be overwhelming evidence and many stocks and groups acting well in addition to the actual analysis of the indexes. But this is also a market cycle system. Then we've got Dr. Wish's GMI signal. If you know who Dr. Wish, he was the person who first introduced me to trading. He's been a CanSlim based trader for over 50 years now, and he's got his criteria and his market cycle system that he's developed based on net new highs, new lows, analysis of the SPY and QQQ, the weekly analysis as well, and then a few other criteria right here. And he basically ranks it out of 6, so the GMI can be a score out of 6. And if it's if it's below 3 for 2 days, basically we enter a red period, and you want to be out of the market. But when it's over three or more for at least 2 days, we enter a green period, and this gets you out of the worst corrections and gets you into the strongest uptrends as well. And we are actually doing a masterclass with Dr. Wish. We haven't announced this just yet, but if you're interested in being the first to know, you can scan this QR code, enter your information, and you'll be the first to know, and you'll get exclusive offers as well to this masterclass. Super excited about this. We haven't announced it yet, but if you want to be the first on the list, definitely go ahead and scan that QR code to join the interest list. All right. So I'll pause here just a second so you guys get that QR code. And let's keep going here. Next up, and this is something that's influenced me a ton, is Oliver Kell's market cycle, the cycle of price action. You probably watched webinars from him on this, and then in the masterclass, he goes incredibly in depth about everything he's looking at during these different cycles here. He looks at this both on a daily and a weekly time frame, exhaustion extensions all the way down to reversal extensions and back again, the wedge pop, EMA crossback. And you can learn more about this in the Swing Trader Masterclass, which I highly recommend. I think it's one of the best resources out there for trading. And we really dive in deep into this. And if you've taken the Swing Trader Masterclass, let us know in the chat and let me know what you think about the Masterclass. All right. Then we've also got John Boyk and how he interprets market cycles more based on net new highs, new lows. You might have seen him post on Twitter that net new high, new low readings really is a great way to stay in tune with, are we in a market where breakouts and new highs are being rewarded, or are we pretty much chopping around? And basically every significant change is identified with these net new highs, new lows. And he went back and studied all these different market cycles, exactly what you should do as you're building your cycle for yourself. And in the class, talked about net new highs, new lows, action of leadership, all that. So again, the historical analysis masterclass, I recommend that, especially as you're building your market cycle system. All right. So I'm going to pause here for just a second because we're going to get into actually an example of building a cycle system. So I want to see if there's any questions before I go into this. Let's see here. I don't see any just yet, so let's go ahead and keep moving forward. So let's dive into creating a market cycle system for yourself. There are 7 key steps to this, and again, remember to keep it simple, especially for your first one. The first step is to choose your time frame. Second step is to choose relevant indicators that apply to that time frame. 3 is start simple. 4 is study history and see how it worked. And then 5 is making your observations based on that study. And then 6 is to build the rules based on those observations, based on those conclusions. And then 7 is iterate, because you're never quite done. You're always going to be tweaking things and interpreting things with new information as it comes to light. So let's go ahead and dive into each of these steps. First, we're going to choose our time frame. We're going to choose more swing position trading style. And we kind of want to operate from consolidation in the market or base in the market to the next one, the next base, the next consolidation, and capture this trend in between them and capture the momentum move in between them. So that's the time frame that we're selecting relevant to this market cycle system. Now we're going to choose some indicators that would help us capture and objectively define that trend. And we've chose the QQQ and the 21 EMA to help us define and capture this trend in the market. You can see how it captures nicely from base to base, and that's exactly what we want to see. And so that's going to be the tool that we use for this market cycle system. And here are some other ideas, like we showed this slide earlier as well, but you could be using moving averages like we are in this case, net new highs, new lows, percent stocks above MA. Some of these are going to be best at extensions. Some are going to be best for more corrections within the context of bull markets. But you kind of want to pick and choose the ones that are relevant to you and that you find and trust, that you find meaningful and trust as well after you're studying things. So again, what makes sense for your style and how do you interpret the market? All right. Then again, we're starting simple. We're just going to say an uptrend is defined by being above the 21 EMA, and a downtrend is when we're below the 21 EMA. So here we're below the 21 EMA, we're in a downtrend, then we pop above it, uptrend, short-term downtrend here, uptrend again. We're going to start that simple, just above, uptrend, below, downtrend. Then we're going to study history. This is the recent price action. We entered a downtrend right here, basically of 2 days off the top here. So it would have protected you really nicely here. And now we're popping above it and starting a new uptrend. You can see how it acted here, captured this trend really nicely. Again, just a few days off the top, protected you during this decline and got you back in shortly here, pulled back, and then got you back in for the majority of this uptrend as well before the chop really started. So yeah, looks pretty good from this angle. Here is some other sample size here, and this includes the market cycle indicator, which you can program using a moving average and the QQQ or SPY. And this basically is counting the number of days we're above that moving average. So there's a really nice visual. If you're building a market cycle system using the deep view indicator, you can really visually show that market cycle as well. And you can see how it controls it really nicely. There's some short-term down cycles as we pop below it, but then we reclaim it and keep trending above it. And it captured these trends really nicely earlier in 2024, which is a really nice trending year as well. Going back in history, this is the 2022 top. It got you out pretty close to the start of the bear market, which is awesome. That's what we want to do. And there were, of course, rallies back into it that just kept moving down as well. Here's some more examples. This is the bottom of the 2023 bear market where we pop above it. And this started the bull market that we were in until, earlier December of last year. And then here are some more examples. This is the COVID crash. Again, it got you out pretty close to the top before the worst of the destruction and got you back in just before, I think, April 6th here as we started the strong 2020 year, which was great for swing and position trading. This is later on that year. It got you out pretty close to the top of this correction and, chopped around here up and down, but eventually got you back in during this trend. Here's going back to 2009, that bottom here. So this is kind of what you want to do. Whatever framework, whatever market cycle you do, go back and study these key events, bull, bear markets, big cycle changes where you would want to be exposed and where you wouldn't want to be exposed, and see, how close to the top did it get you out? How close to the bottom did it get you in? Are there a lot of false signals? Because here there are some false signals up and down, but did it catch the meaningful trend that you really want to be a part of? That's the biggest thing that you want to look at. Then here is 2015 with this big crash. You can see it got you out, right here before the big expansion down. And again, after you collect all this data, you want to write down observations. And here's some observations based on looking at all these different instances and historical periods. The 21 EMA catches powerful trends really well. During choppy periods, there can be a lot of false signals, so that's something to keep in mind. During a strong uptrend, the QQQ, it can dip below quickly for a day or two and then recover. We saw that back in 2024. It can be activated with straight off the bottom moves that then pull back and either chop around, and it protects really well against market decline shortly at the top. So overall, a good system, but again, we do have to be aware that there can be some false signals. So based on those observations, here are some rules to help aid with that choppiness. We've, instead of just having that simple close above or below, we've said it has to be two closes above or below. So the uptrend is defined as two closes above the 21 EMA. The downtrend is defined as two closes below the 21 EMA. And during an uptrend, the first few days of the market cycle start with 1/2 positions, and with positive trade feedback, scale quickly to full size. That's the rules associated with an uptrend. And then the rules associated with a downtrend are no new buys when we break below the 21 EMA, two closes below. Consider selling partials on the weakest positions, and then treat individual positions based on their own merit, based on your own personal sell rules into weakness. Likely, these are going to be triggering right as the market also breaks below the 21 EMA. But that's kind of how you go from observations to the actual rules that you develop related to your cycle. Step 7 is to iterate. Do post-analysis with each new market cycle and just see, how did your market cycle improve? When did it get you in? When did it get you out? Would you have wanted to get in earlier, or was it, did it do a good job of protecting you from the chop and really get you in during the meaningful trend? Think about what can you do to improve it, and also how can you simplify it? Because again, simplicity is robustness. Simplicity and robustness allow you to allow it to work well during many market cycles into the future, and you're not overfitting to previous market periods. Like, you're not saying, oh, I need to use the 23 EMA versus the 21 EMA because it does better, or the 21-day simple instead of the 21 EMA, because that's not really the point. The point is to have a general guideline that governs how you enter or exit the market based on these market cycles. The goal is not to overfit and be so specific that it's going to get you to miss out on potential new opportunities down the road because you overfit to a previous market cycle. The goal is to be robust and for this to apply to many market cycles into the future. Here is kind of my market cycle system, just to give you an idea of how I do it. It's basically the same thing we just went over, but a little bit of tweaks. Depending on the power or negativity of a bar as we reclaim or approach the 21 EMA, I might start my market cycle early instead of waiting for two closes above. And I might turn it off with just one close below 21 EMA or one bad drop off the top, because I've noticed that I can anticipate, based on my experience, a little bit better. Instead of waiting for two closes, if there's one really bad bar, I know that the environment is shifting a little bit. And in addition to the kind of more objective 21 EMA filter, I also analyze the strength of the market leaders like we did with Reddit and PLTR and take note of that and incorporate into that into my analysis to define an uptrend or downtrend. If we're all of them are breaking off highs as we saw previously, I might start my down cycle a little bit earlier than the 21 EMA based on that negative action. So once I've defined an uptrend, as the market and stocks look set up to start uptrend in the next few days, I look to position up to full positions in 2 to 4 of the top ideas / TQQQ, risking about 2% of my equity. That's what I'm willing to risk to try a new uptrend. And then with positive feedback and progress, I become more aggressive and increase exposure pretty quickly, trying to get 100% or even a little bit longer than that in my account. In a downtrend, my rules are no new buys, considering partials on weakest positions, and then treat individual positions on their own merit based on cushion. So if I'm up 60% of a position and, I'm just going to kind of use my existing sell rules to manage that position instead of just selling because the market is potentially entering a consolidation period or pullback period. So these are kind of my rules. So hopefully they can help you define for yourself a starter system, foundation system that then you can tweak and work off of. Key reminder here. Again, I've said this a few times. Rai mentioned it as well. Simple equals robust. And the closer the signals are to price, the better. A lot of the secondary indicators, are a lot of noise. So again, you have to study them and see if they work best at extremes. Should you even consider them? Make sure to study them before you trust them. There's no perfect system. Some will act too late. Others will give you too many false signals. Study and find a way that works for you. This is key. Breadth, thrust, oscillators, indicators. Study it for yourself over many market cycles before adding it to your process. Borrowed conviction is not enough and won't serve you well over the long term. This is a key reminder. Some key summaries here. Market cycles are a technical representation of human psychology. Cycle phases determine the effectiveness of different strategies, different setups as well. You might focus on breakouts early in an uptrend and then pullbacks in the middle and late stages of an uptrend. You need a system for determining these phases and how to act to help improve your equity curve as well as limit drawdowns off highs. And a market cycle system helps do just that. It helps smoothen and enhance your equity curve, manage risk, and limit drawdowns. And that's the ultimate goal, and that can be a key stepping stone to transitioning from stage 1, 2 to 3 and 4 in your trader journey. So that is it for today. I'll answer a few questions here, but just a reminder, if you find these webinars helpful, we expand even more in the book and expand on things in a different way, give more examples. And if you found these webinars helpful, you guys are going to really love the Trader's Handbook. I'm really excited to actually get this in your hands, and it's so cool to actually see it in real life. So highly recommend picking this up. If you haven't yet, pre-order it. It's available on Amazon on the link in the description. And we'll have a lot of special bonuses announced for people who've actually pre-ordered, extra market cycle model books, all that stuff. So definitely go ahead and pick this up. You're not just getting a book, you're getting a whole resource associated with the concepts that we're teaching. This is really special because the foreword was written by Dr. Eric Wish, who first introduced me to trading and probably saved me years of frustration and losses by emphasizing risk management, emphasizing trading with stage analysis, can slim, focusing on the right names. And he was able to actually write the foreword, which is really special. Excited for you guys to read that of this book. And we really hope that this book can do the same that his class did for me by saving you guys time, saving you guys years of frustration, especially newer traders out there. And even for the advanced traders, there's a lot of great concepts in this book, in addition to, of course, the model book at the end of the book. That we've got an entire chapter of 200 plus anti charts showing reversal extensions, showing oops reversals, range breakouts, all of that. So there's something for everybody in this book. We've given early copies away to Peter Brandt, Oliver Kell, all these top traders, and they've given us great feedback. So excited for you guys to pick up as well, and hopefully enjoy it immensely, and hopefully it can be part of your key trading library. So thank you guys so much for attending. Let's see if there's any questions here. Let's see. You mentioned TQQ. What about other 3x leverage ETFs, XPSL, FNGA, Teckle? Those are all good as well. I know a lot of people do SOXL as well when the semis are acting well. Just pick one, study it, and see if it works for you. I like TQQQ because I focus a lot on the QQQ, and the TQQQ, when it's doing well, my names and strategy is going to be working well, so that's why I use that one. Let's see here. On the market cycle indicator DFU, there's a stress test indicator. What do the criteria in the stress test? Basically, it defines the spacing and time where stress tests might occur. So we talked about 5 to 7 days, you might see your stress test. We labeled that on the market cycle so you can kind of get a gauge for when to start to expect that stress test. So really good question there. How do you identify the main theme best industry groups? We talked about that a little bit today. Keeping your RS list every single day, identifying any common themes among that RS list. But we'll dive even deeper into that in the screening routine section as well. Harpreet says highest RS rating stocks could be extended and exhausted. How you sort the list of the max 3 stops. RS rating is good. It's a good filter, but you always want to look at the charts itself in terms of identifying relative strength. It's good for screens and getting kind of that base criteria, but usually in my screens, I say RS rating over 85 or 90, and then I look through everything manually or look for other criteria as well. Any scanners help with picking the best or just need to know? DFU, we build in so much stuff in terms of RS, line before new highs, oops reversals, all that's built into DFU. So that's a great way to, save time when looking for stocks showing relative strength. That would be my recommendation to visit dfu.com for sure. All right. So that's pretty much it for today. Again, guys, thank you so much for attending. Appreciate you taking part of your Saturday to be here with us today. Hopefully you found it helpful. And definitely go ahead and pick up your copy of the Trader's Handbook. You can scan this QR code to order it today. I believe it's a little bit on sale on Amazon right now, so definitely pick it up if you haven't already. And I really look forward to getting it into your guys' hands, and hopefully you guys will enjoy it immensely, as I know you will. So thank you so much again for your time, and we'll see you guys in the next one. Cheers.